Dow Theory. Okay, so let's start our lecture by talking about Dow Theory. Dow Theory is based on the writings of an individual investor named Charles Dow, and he was a very famous investor in the late 1800s, and he created the Dow Jones Index, the different Dow Jones indices. So when we look at the markets today, for example, in the US market we have the Dow Jones Industrial Index. Well, it's named after this guy, Charles Dow. He also created the Wall Street Journal, which is a very influential newspaper in the financial press. So that's Charles Dow. What about Dow Theory? Well, Dow developed many concepts and understandings about how markets work. And he essentially developed a theory of trends. And it really forms the start of technical analysis. So his theory is the first theory about trends and the first theory about technical analysis. And he also looked at sectors. So he also looked at how different sectors of the economy should interact with one another, and how different stocks of different sectors should interact. And as a result, it's created some of the other Dow indices. So we have the transportation index, we have a manufacturing index, all courtesy of Charles Dow. And out of Dow Theory, now as we said, Dow Theory is very old, one of the first technical analysis theories. There have been many newer and more complex forms of technical analysis. So what we'll see is when we go through Dow Theory, we'll see that it's fairly simple and fairly simplistic. And that's because it's actually one of the first theories out there. And what we'll see is that a lot of the newer technical theories that exist today that we use in practice, a lot of them originate from Dow Theory. And this is why it's so influential and so important. So even if it seems simplistic, it's important to remember that these are really the building blocks for the field of technical analysis as a whole. And just the idea that we can look at charts and we can look at trends and we can make decisions on how to invest based on these factors. Basic tenets. What forms Dow Theory are 6 tenets. Tenets are sort of statements of fact that the theory claims to be true. So Dow Theory is comprised of 6 of these, and these 6 of these tenets essentially describe how the market works. So we'll go through these one by one. The first tenet, the market discounts everything. What this means is that the price of a stock, i.e. the market price of a stock, already incorporates all the fundamentals about that stock, which implies that the market is efficient. So for example, if a company has particular earnings, it has particular features about it, this is all incorporated into the stock price. The second part of that is that the stock price also incorporates expectations about the future. So for example, if a company is expected to have earnings of X in the future, then this is already incorporated into the price of the stock. Now let's think about what the implications of this are. The implications are almost that fundamental analysis is not very useful, because what this tenet is saying is that the fundamentals are already incorporated into the price of the stock. So therefore, you cannot necessarily make money by learning about the fundamentals, because it's already incorporated into the price. Now this is a contentious point. Obviously many people would believe otherwise, but this is one of the cornerstones of Dow Theory, and one of the cornerstones of a lot of technical analysis theory as well. So that's the first tenet, the market discounts everything. The second tenet, the market has 3 trends. Now we get a bit more into the technical analysis side of things, and according to Dow, the market has 3 different trends going on at the same time. There is the primary trend, which is a long-term trend, and this is normally measured in up to a year or multiple years. There is an intermediate trend, which we normally measure in periods up to 3 months, and there is a minor trend, which we measure in periods up to 3 weeks. And the relationship with the primary trend and the intermediate trend is quite important, because the primary trend, for example, will go in one direction. Let's say the primary trend of the market is up. Within that primary trend, there will be intermediate trends going the other direction, right? So intermediate trends may retrace between 1/3 to 2/3, and usually Dow estimated to be about a half of the previous move, right? So if a stock goes from 100 to 200 as part of the long-term trend, the intermediate trend might see it go from 200 to 150, right? Retracing half the move. And then minor trends are essentially very short-term trends, up to 3 weeks, or it can be a few days. And prices, the trends goes up and down regularly within that. Basic tenets. Now we'll talk about tenets number 3 and 4. Tenet number 3. The market trends have 3 phases. Now this is separate to what we said earlier about market trends, there being 3 different trends. Now we're saying that there are 3 phases to a market trend. And usually this will refer to the long-term trend, but doesn't have to. So the first phase is the accumulation phase. The accumulation phase is informed buying by intelligent investors. So this is when the intelligent investors who are highly skilled, know something about this stock, start buying. The second phase is the public participation phase. In this phase, news of the stock starts to spread, and the public begin buying at large. And once the public start buying, prices of the stock start going up. And this, of course, leads to more buying and prices continuing to go up. Then we get to the distribution phase, which is essentially the height of the boom, when the stock price has reached close to its highest levels. And this is when the informed investors that bought in the beginning begin to sell. And then after this, we'll see the price go down the other way. So that's tenet number 3. Tenet number 4. Market averages must confirm each other. Now when Dow talked about market averages, what he was referring to were different sectors of the economy. So for example, the Dow indices, which contain, for example, the Dow Transportation Index, the Dow Manufacturing Index, Dow Industrial Index. And what he said was that for any trend to be confirmed, the complementary sectors must move together, i.e. they must confirm each other. So for example, if we have manufacturing stocks rising, right, let's say we have an index of manufacturing stocks that's going up, because manufacturing needs railroads to have the goods move around. Okay, now we're talking about a particular time when railroads was the way goods moved around, maybe different now. But essentially, if manufacturing is doing well, then the demand for railroads should increase. So rail stocks should also be doing well. So if we see an uptrend in manufacturing stocks, we should confirm it by looking at the behavior of rail stocks. If rail stocks are also going up, then they confirm each other. But if one is going up and the other is not, then it could be a sign that this uptrend may not be sustainable. Basic tenets. Now we'll go on to the final 2 basic tenets of Dow theory, numbers 5 and 6. Basic tenet number 5. The volume must confirm the trend. Now in addition to using the price, we can also use volume as an indicator to tell us about what's going on in the market. And Dow considered volume to be a secondary indicator to price, that is not as important as price, but still important. And what he said was that for a trend to be valid, the volume must increase in the direction of the trend, specifically the major trend. So if we see stocks going up, right, let's say the major trend of a particular stock or stock index is upwards, then for this to be valid, we need to see volume increasing as the prices go up. And conversely, when prices go down, we should see maybe less volume. Now, why is this important? Well, the more volume there is, the more market participants there are. So Dow believed that if prices move alongside rising volume, then it meant that the entire market was convinced by the price move. Right? So if there's an uptrend and there's lots of volume, high volume with that uptrend, it means that the market is convinced of that stock going up and being worth more. And what we should also look out for is that if a price moves without rising volume or it moves with falling volume, then it is more likely to be unsustainable. Okay? Straightforward enough. Finally, basic tenet number 6. A trend is in effect until definite signals that it has reversed. And this is one of the challenges of trend analysis and of Dow theory, is that we need to know when a trend has changed. Right? So if the primary trend is in a particular direction, we need to know when it changes. So according to Dow theory, we have to assume that a trend is in effect until there are definite signals that it is not. Right? So this is why we have the intermediate trend. So markets will move sometimes in the opposite direction. That's the intermediate trend. But then they will resume their prior uptrend in the primary direction. And unless we see a fall significant enough that it's no longer an intermediate correction, right? It falls below what would be considered an intermediate correction. If you remember, we talked about intermediate correction as being between 1/3 and 2/3 of the move. Until that occurs, we cannot say for sure that the trend has changed. And this is, of course, one of the many challenges, as we just discussed, and we'll go on to talk about it more later on. Let's now continue our discussion on Dow theory by going through an example. What we have here is a chart of the Nifty index from the start to the end of 2011. Right, so this is a one-year chart of daily closing prices of the Nifty index. Now I've taken this from the NSE website. You can look at it yourself. And we have the price on the top part of the graph, and we have volume on the bottom part of the graph. Now what I want to do is two things. I want to, one, show you the different trends according to Dow theory. Right, so we have the primary trend, the intermediate trend, and the minor trend. And then I also want to look at volume. Right, so look at volume indicators as well. Now we will make use of this graph throughout this lecture. So when we discuss the other concepts within trend, we'll also use this graph. And you can do this with any graph. I suggest you download some data of your own, get maybe a graph of the same thing or something else if you want, and try and do this analysis. So let's get started here. So if we're looking at the primary trend, what we can see is that we start off sort of fairly high up there, and the price kind of steadily declines going this way. The overall direction of the price is downward, right? All the way up to here. And what this means is that the primary trend, according to Dow theory, would be negative, right? Because prices are kind of falling over time. Now within this negative trend, we have here intermediate trends as well. So that's over a kind of couple of month period, right? So we have, for example, here to here. That's an intermediate uptrend. We have, for example, here is an intermediate uptrend. So within this primary downtrend, we have here these intermediate uptrends. And then, of course, these little ones here, like for example here or here, all these smaller movements we would consider the minor trend. So what we can learn from this is that we can see that the different types of trends that Dow theory tells us will occur. And we can see it occurring in this chart. Okay? Let's now quickly take a look at volume. So can we see here, for example, that volume is a useful indicator? Well, what we see here, for example, is that, see, as the price is going down here, okay, we can see volume has at the same time been going up. Okay, and here, for example, as the price goes up, volume is going down. So this kind of confirms what Dow said, right? So when we're looking at the primary trend, okay, which is downwards, the volume is increasing on that trend. That confirms the downward trend. But when the price is going up, the volume here is decreasing. So that casts doubt on the fact that this is an uptrend. So this confirms really that this is a downtrend. The volume kind of confirms what's going on. Okay? So let's now carry on. So we'll now conclude our discussion on Dow theory by looking at some of the empirical evidence. That is, if we actually use Dow theory, what happens? Essentially, we're going to use Dow theory to identify trends, right? And when we identify trends, we trade in the direction of the primary trend. And often we'll use the intermediate trends to time our trades. So let's say the primary trend is upwards, and the intermediate trend, of course, then is downwards. So every time there's an intermediate trend downwards, okay, then that becomes a buy signal for us to trade in the direction of the upward trend. So there have been some studies done on the effectiveness of Dow theory, and some early studies which performed Dow theory analysis on the Dow Jones Index showed that it did not outperform a buy and hold strategy. So it made money, but it didn't make as much money as simply buying and holding the index. So that was some early evidence. Later evidence refuted this a bit. Later studies show that actually on a risk-adjusted basis, Dow theory was much better. And the reason for this is that during bear markets, Dow theory did very, very well. It was well able to identify downtrends to tell you to get out of the market or go short. So if we look at the stock market as a whole, there are many periods of downtrends where if you're a buy and hold investor, you suffer through those downtrends, right? You have to hold the stock even if there's a multi-year recession, etc. So from this evidence, if we use Dow theory, we can identify these downtrends and avoid trading during those times, or even take short positions. And by doing this methodology, we can show that Dow theory does outperform buy and hold strategy on a risk-adjusted basis. Now, one of the main criticisms of Dow theory, one of the reasons that it's not the best, is that trends are identified fairly late when we use Dow theory. So often a good portion of the move will already have occurred before we can identify a trend. Now, if you remember, one of the tenets was until we have a definite signal that the trend is reversed, we have to assume the current trend is going on. So then it may take us a while to come to the conclusion that a new trend has occurred. This is one of the criticisms. Of course, there are now many more newer trend-following strategies, which we'll learn about later on in the course. But a lot of it is based on Dow theory. So a lot of technical trading strategies, a lot of trend-following strategies are based on the principles of Dow theory. And this is why Dow theory is so influential. So even though it's because it's the first theory, it's not going to have the best performance, but it has led to the huge field of technical analysis today. Trend. This now concludes our discussion of Dow theory. We'll now move on to the next part of the lecture, where we'll talk a bit more about trend. So when we talked about Dow theory, we talked about different trends. So now we're going to take a step back, and we're going to talk a bit more generally about what is trend. A trend essentially is the direction of the market, right? So we have the market's going up or the market's going down, right? So a trend is telling you the general direction of which way the market is moving. So let's think about this a bit more formally. How would we define it? Well, we know that markets do not move in a straight line, right? They zigzag, they go up, they go down. So if we look at any charts, what we will see is that we have peaks and troughs. So peaks are the higher points, so an up move followed by a down move. Trough is the lowest points, low move followed by an up move. And when we're thinking about what constitutes the market trend, what we want to look at is the direction of the peaks and troughs. So if the peaks and troughs are moving upwards, that's an uptrend. If the peaks and troughs are moving downwards, that's a downtrend, and so on. Now, trend is very important because most of technical analysis is concerned with identifying a trend and trading in the direction of that trend. Now, many of you may have heard a very well-known sayings like the trend is your friend, or always trade in the direction of the trend. And because if we do this, obviously we'll make money, right? If we have an uptrend and we trade in the direction of that uptrend, we can make money. Likewise with the downtrend. So really what we're going to be looking at when we do technical analysis is identifying trends. We're going to identify trends and try and trade to benefit from those trends taking place. Trend direction. So far we have been talking about two different directions that a trend can be. Trend can be upwards, an uptrend. A trend can be downwards, a downtrend. And as we defined earlier, an uptrend occurs when prices are rising, and a downtrend occurs when prices are falling. There is, however, a third important direction. So trends can move in three directions, not two. The third important direction is what is known as a sideways trend. A sideways trend occurs when prices are moving horizontally on the chart and within a trading range. What this means is that during a sideways trend, the price stays within a particular range and doesn't really move up or down. Now, it's always the case, for example, that prices are changing, right? So prices are never constant at a particular point. But however, they can move within a range. So they can go up, they can go down over a long period of time, not really change much, right? So this is a sideways trend. Now, it's estimated that markets can spend a significant portion of time just going sideways, that is, not moving up and not moving down. And this will vary by market. So some markets have a lot of uptrends and a lot of downtrends and very little sideways movement. Some markets have more sideways movement. So it's really up to us to determine which markets have more uptrends and downtrends and which markets have more sideways movement. Now, sideways trending is very important because if we look at most trend following systems, like Dow Theory is an example of this, they tend to do very well during uptrends and downtrends. So they're good at identifying when an uptrend is taking place and taking advantage of it. The same with a downtrend. However, they perform quite poorly during sideways trends. Right? So if a price is going up and then our trading system identifies at the start of an uptrend, if it's actually a sideways trend, then the price will just come back down after that. So we'll keep getting what is known as whipsaw, right? So trend following systems tend to do poorly during sideways trends. And this, I want to emphasize, a very important part of technical analysis and investing in general. So knowing when to stay out of the market, that is, i.e. whenever there is sideways movement, is as important as knowing when to enter the market during an uptrend or downtrend. So we need the tools to identify uptrends or downtrends. We also need the tools to identify a sideways trend. Because when we identify a sideways trend, then we know not to trade, right? Or adjust our trading strategy to benefit from a sideways trend. But not necessarily to do trend following, trying to play an uptrend or downtrend. So trend direction then is very important. Trend classification. Trends can be classified into major trends, intermediate trends, and near-term trends. The near-term, of course, is like the minor trend we discussed before. Now, we can have more classifications if we want to. So we can have 4 categories of trends, or 5, or 6. And in general, each of these will represent a specific time period. So the major trend is the longest, then intermediate is shorter than the major trend, and near-term is even shorter. Now, when we did Dow Theory was essentially a special case of this, because Dow identified major trends as being up to a year and more, intermediate trends being up to about 3 months, and minor trends being up to about 3 weeks. So Dow Theory was very specific about the time frame of the trend. But actually, if we look at it more generally, we can create time frames as we like. So our major can be 5 years, 10 years, intermediate can be 1 year if we want to. Or we can have major be 3 months and intermediate be a week. Right? It all depends. It depends a lot on the market we're looking at. So if we're looking at, for example, a futures market, because futures markets tend to be much shorter term, our major, intermediate, and near-term trends will be much smaller in length. Alright, so the first thing to know is that we can adjust these by the length that we want. And like with Dow theory, this one principle is the same thing. So the intermediate trends represent correction in the major trends. So if the major trend is upward, an intermediate trend will be a downward correction of that upward trend. And of course, if it is just a correction, it is assumed that the price should continue back in the direction of the major trend. Now, what is the near-term trend? Well, within these corrections, or within the direction of the primary trend as well, we have short-term up and down movements, right? So market will go up for a few days, then fall for a few days, and this represents the near-term trend. And we generally don't use this that much. We tend to use the intermediate trend and the major trend in order to create our trading strategy. So a very common trading strategy is to trade in the direction of the major trend and time it to follow an intermediate correction in the trend. We discussed this a little bit earlier. Let's just think about how this would work. So if the major trend was upwards, I would then look for an intermediate correction, that is a downward correction, or let's say 1/3 to a half of the move is retraced. Right, so it's fallen by 1/3 to a half of what it gained before. And after that fall, I would look to buy the asset and benefit from its likely continuation of its previous major uptrend.